Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. The one single pattern had been the cause of rising prices seen here throughout July, a pattern I highlighted 4 weeks ago, a bright pink June and early July based diamond bottom pattern, and the move up easily reached its primary and harder to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently at 636 even, the 50% Fibonacci line, the May 24 to May 25 move at 622 and a quarter, and the March 24 to May 25 move at 651, plus the important 50% absolute Fibonacci line at 682. But we started to slow at the bright red neckline extension, which is currently 711 even, of the small October to November 2020 head and shoulders top, plus the October 2013 high at 720 and a half, and finally halt at the March 2014 high at 725 and a quarter, though one could argue that it was the approach to either the connected highest trend line of March to date, which is currently at 746 and a half, or the bright green upper time, currently at 753 even, and I would take either of those as legitimate. The pullback lower started 2 weeks ago, set off with a pretty impressive, if unusual, key reversal down, pushing below the 50% absolute Fibonacci line at 682, and stabilized under it. To help in these subsequent moves, I said 2 weeks ago, and I quote, "Just in case the 50% absolute Fibonacci line does not hold up, I have drawn a new Fibonacci for the recent action with the 50% Fibonacci line at 651 even. That would be the one to watch, as it also fills in the gap left on the way up." Now, one more thing to say, and it's to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we have seen further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some or all of the run-up. A rough median is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation, also in the other grain markets as well. End of quote. These comments still stand, but I would like to add one further previous observation made last week and a new one for this week. This is the one from last week, and I quote, "It concerns the market's actions over mid to end of July. You see, we have formed a small irregular head and shoulders top, a dark blue neckline, which is currently 743 and a half. We have breached that dark blue neckline, but that is all the market's managed right now. It is not a break just yet, so I cannot give targets below, but I can offer some potentials for a further move lower. Thus, a primary potential will be down in the 625 and a quarter zone, just above the 50% Fibonacci line of the May 24 to May 25 move at 622 and a quarter. The secondary hard reach potential down in the 591 and a three-quarter zone, just under a lot of congestion between 592 and a quarter to 594 and three quarters. The obstacles in a way are fairly obvious and fourfold, and they are filling in the mid-July gap, the recent 50% Fibonacci line at 651 and a quarter, the green short medium moving average, and the mauve medium moving average." End of quote. These observations still stand, as we haven't really broken the neckline, just breached it a couple of times and reversed back upwards. The new observation this week is a steep observation to regard the whole head and shoulders action from mid-July as a possible descending wedge pattern, a cusp mid-August. We likewise have today just breached this pattern, so I cannot give targets as yet, but I can give some potentials. Thus, for a confirmed break lower below the dark blue neckline, we would have a primary potential of minus 24 cents below the dark blue neckline and a secondary harder to reach potential of minus 82 cents below the dark blue neckline. Conversely, for a confirmed break higher, which we're starting to have the beginnings of, but for a confirmed break higher above the dark blue upper trend line, we would have a primary potential of plus 51 cents above the dark blue trend line and a secondary harder to reach potential of plus 82 cents above the dark blue trend line. I may finesse this as the big picture becomes clearer. My only concern is that this might turn into a bear channel pattern. Chicago corn. The market from mid-May moved down between May and June until it reached a very, very substantial support. The dark blue May 2020 to date uptrend. That's right, a 6-year-old uptrend that still works. Currently at 407 and a quarter. At this uptrend, the market formed a pipe bottom and rallied, really rallied, gapping rallied out of the prior pattern, a bright red descending expanding wedge pattern. Easily reaching both the primary and secondary targets for this pattern, as well as through the three main moving averages, the gold long moving average, currently at 451 even, green short medium moving average, currently at 447 even, and the mauve medium moving average, currently 456 and a half. In addition to these, prices overcame the pink lower trend line, currently at 452 even, of the July 23 to January 2024 descending triangle, and the 50% Fibonacci line for the whole of 2025 at 454 and 3/4. So all in all, overcoming some pretty heavy duty resistances between 447.5 and 454 and 3/4, shooting all the way up to the congestion we saw back in May from the double top, Adam and Eve type, between about 460 to 485 and over the purple neckline, currently 476 and a quarter of this double top, but finally pausing at a wide but somewhat sparse overhead congestion band between 490 and a half to 497 and a half. And that's containing the April 25 higher falling at 497 and a half. 2 weeks ago, I was not sure if this move up had been done yet, as 2 Fridays ago was not a big key reversal down as we have seen in international grain markets. But instead here, it looks like it was a long-legged yet indecisive spinning top, one that could also be called a key reversal up, if only by a little, but still up. Apart from the earlier congestion that's been mentioned overhead, what I can say is this market was topped by another specific new congestion, part of a new large pattern. The market was capped by the bright green upper time, currently at 492 even, of the bright green mid-August 25 to late June 26 bullish shift pitchfork. This is a good pattern, and we have followed on lower after being capped. Thus, on the downside, as I said 2 weeks ago, and I quote, we have some resistances that are now supports, ones already mentioned, plus 3 new ones. The bright green middle time and a new 50% Fibonacci line for the late June to July move up at 449 even. Quite a lot around the 449 area indeed, as we have a gap left over between 440 and a quarter to 458 and 3/4. End of quote. I also had another piece to say about the actions 2 weeks ago when I said, and I'm afraid it is a long piece, and I said, and I quote, now I have one more thing to say, something I've said in the grain markets, but it also applies here in corn, and is to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some or all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes more problematic. End of quote. Oh, sorry, this is worth considering here in this situation, and that's the end of the quote. These comments still stand, and I added an observation last week, and I quote, it concerns the market's actions over mid to end of July. You see, elsewhere in the grain, prices have formed sometimes a small irregular head and shoulders top, However, this pattern is not so clear here, and indeed could be argued that it does not exist, so I will not be setting it up on my daily chart here. I thought you should know. End of quote. Now this is still valid today, and indeed I can expand on that, as I think we now have, unlike the other grain markets, a different pattern formed since mid-July, a dark blue bear channel, currently 446 even to 466 even. Quite nice looking one as well, if quite steep. Needless to say, we are still within the bear channel, but we are now testing the dark blue upper bear channel line right now. Kansas City wheat. Much like Chicago wheat, one single pattern has been the cause of the rising prices seen here throughout July. A pattern I highlighted a few weeks ago, a dark blue late May to early July based diamond bottom pattern. The gapping move up seen mid-July easily reached its primary and harder to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently at 681 even, the 50% Fibonacci line of the big 2011-2019 move at 691 and a quarter, plus the important 50% absolute Fibonacci line at 697 and a quarter. But we started to slow at the newly drawn dark blue upper time, currently at 793 and three quarters of the mid-December 25 to late June 26 bullish shift pitchfork. There was also congestion dating from July 23 up at 787 even and 790 and three quarters that eroded the bullish incentive enough to cause what we saw 2 Fridays ago, an unusual with pretty impressive, very large daily key reversal down. Now, the market back then dropped down through some congestion between 760 to 760 even to 764.5, containing the May 24 high at 760 even. However, prices started to hesitate and slow its descent between just under 740 to 748, the latter being the 2022 and June 24 low. I added 2 weeks ago, and it's quite a long if valid piece, and I quote, "There are a number of supports to know what to look out for. Obviously, we have the dark blue middle time, currently at 711 and three quarters plus. Just in case, I would also keep an eye on a pair of 50% Fibonacci lines mentioned earlier, plus the new June to July 2026 50% Fibonacci line nearby at 701 and three quarters, as well as the gap left on the way up further down between 678 and three quarters to 690 even. The gap below is one to watch. Now I have one more thing to say, and it's to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen about 2 out of 10 times, we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some of all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes more problematic. This is worth considering here in this situation, also in the other grain markets as well. End of quote. Those comments still stand. And I also added the following comments last week, and I quote, "One further observation that concerns the market's action over mid to end of July. You see elsewhere in the grains, prices have formed sometimes a small irregular head and shoulders pattern. However, this pattern is not so clear here, and indeed could be argued that it does not exist, so I will be not be setting it up on my daily chart here." End of quote. This still also stands, but I would like to add the following new observation this week, and it is a steep observation. It is to regard the whole supposed head and shoulder action from mid-July, instead of a possible very steep descending wedge pattern from instead of the whole head and shoulders action from mid-July, instead looking at it as a possible steep descending wedge pattern with a cusp in early September. We've breached this pattern on the upside today, though we haven't broken it yet, just breached it, so I cannot give targets yet, but I can give some potentials. Thus, a confirmed break lower below the bright green lower trend line would have had a primary potential of minus 27.5 cents, whereas below the green, the bright green lower trend line, and a secondary harder to reach potential of minus 95 cents below the bright green lower trend line. Conversely, for a confirmed break higher above the bright green upper trend line, we have a primary potential of plus 59 cents above the bright green upper trend line, and a secondary harder to reach potential of plus 95 cents above the bright green upper trend line. I may finish these as the picture becomes clearer.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.